Morningstar recently released its biannual Global Fund Investor Experience Study, a report we first issued in 2009. The study is really about taking a look at the experience of fund investors around the world. We look at 25 different countries from North America, Europe, Africa, and Asia Pacific. The study breaks down into four main areas: regulation and tax, fees and expenses, disclosure, and sales and media. We'll talk a little bit about each of those in a moment. But overall, I think it's fair to say that investors in 2015 stand a far better chance of doing better than they did in 2013. This really comes off the back of a raft of regulatory changes that we've seen implemented around the world. Fund companies in many markets also voluntarily stepping up to the mark to help. And I think more broadly, the industry recognising that it needs to move forward. So let's take a look at each of those areas. When it comes to regulation and tax, we're looking for active regulation in a market, a regulator who enforces the rules that are in place, and also a regulator that tries to adapt with the market and implement new regulations as they come through. I think this is the area, as I mentioned, where we have seen many markets, in fact most markets, implement some form of change over the last 2 years. Taxation, well, no surprises from the perspective of a fund investor. Taxation is really about paying less. And what we find here is that the Asian markets continue to lead in terms of low tax rates, with the Nordics, Scandinavian markets paying some of the highest taxes. Now, a lot of that is about tax rate. So when you talk about Hong Kong and Singapore with practically zero tax rates on their managed funds, and Thailand also rewarding long-term investors with a tax credit, they're at a clear advantage to some of our higher tax rate markets. The other interesting thing about taxation is which markets are actually providing a benefit to their to investors to invest in funds. So, for example, Australia and the US, there's no real advantage to investing through a mutual fund in those markets from a tax perspective. Also, with a lot of countries struggling with their budgets, it's no surprise that taxation is probably one area we haven't seen a lot of change over the last 2 years. Moving forward, fees and expenses, always an important area for any investor. And I think this year in particular, we wanted to take a closer look at what really drives some of those expenses. We're seeing in Australia, the US, the Netherlands and South Africa markets where fund fees typically now are unbundled. And what I mean by that is the fund fees there really just represent the cost of owning the fund and no longer include any sort of payment to an advisor or a sales agent for distributing that fund. Now, this is an important distinguishment because when you look at the fees for those markets, they do come out in many instances to be quite competitive. So if you're owning that fund and only paying for that fund, this is a really good outcome. And you can experience this in the US and Australia where funds are quite often bought directly. But if you move that into a market where funds are quite often still bought through a sales agent or through an advisor, so for example South Africa, where you're going to be adding on top of that fund fee an additional 1 to 1.5% for the cost of advice and platform, then clearly the fund comparisons need to be a little bit different and you need to take that into account. So unbundling is certainly a trend that we're seeing, but the majority of markets in our study still include some form of advice fee in their ongoing fees charged to investors. The other part of costs come down to front loads, i.e. what sort of entry fee are you paying? Once again, this is largely about fees that are being paid for advice at that point. This fee is still very popular and prevalent in many markets. Australia, US, Netherlands, UK are some markets where you find it less. In Asia, front load fees are still there, and whilst an ongoing fee might be quite competitive, if you're paying a lot to get into the fund, you need to be aware of this. So we're expecting to see even more activity, I think, over the next few years about this front load fee and how it is actually charged. Moving on, the other area is sales and media. This is an area where we actually increased the weighting when assessing the overall score in 2015. Why? Because as we've seen in many markets, if you get the sales practices right, investors stand a much better chance of doing better when they're buying and owning those funds. This is about fiduciary duties of an advisor. It's about the sort of distribution channels that are available or ways that investors can buy funds. It also comes down to whether or not when you go to buy a fund, are you going to have the choice of an open architecture or a choice of funds from many companies or just one company? When we look at across these 25 markets and we try to ascertain what is the dominant way in which managed funds are taken to the public, it's in 22 out of 25 markets, it's all about banks and insurance companies being the dominant force. The next one is the independent advisor, and that is only named in 7 markets. So, sales, media, very important. We do look for countries that promote through their media good education about funds, that are talking about funds honestly. And in this year, we also included the World Press Freedom Index in our assessment of the media, looking for an unbiased, impartial media commentary on the markets. Lastly, disclosure. Disclosure is something Morningstar has fought for many years. We think open disclosure around fund investing is the best and important way to secure a good outcome for investors. This comes down to having the right information at the point of sale. And once again, around the world, we've seen a really good trend towards simpler documents, explaining one fund at a time and making relevant information available in a usable fashion. This has been a really good step. Disclosure around fees. Big steps taking forward. Probably the one area we think more work needs to be done globally is around performance fees. And another point is portfolio holdings disclosure. We did a lot of work on it this time because whilst our study has focused on regulated disclosure in the past, we also wanted to observe what managers are actually doing. And for example, with portfolio holdings disclosure, whilst regulators require this semi-annually, what we found when we're looking at actual practices around the world is that most managers are providing portfolios monthly. And of the 25 markets we looked at, Australia is now the only market with no implemented, regulatory or regulated form of portfolio holdings disclosure. New Zealand has implemented it, and Thailand is now improving their disclosure requirements. We think this is going to help people understand their funds a lot better. So, in closing, this is an extensive report covering 25 markets involving many hours of work by our experts around the world. We think it shines a light on some of the best practices that are happening in the market, and we hope it serves as a catalyst for even better practices moving forward. Thank you.